Yes, so I'll be talking to you over the next 10 minutes about the latest changes in prices and trade flows that we're seeing in the global market and the big shift that we've seen happening in the global market recently. So I'll just, Kenna, will the slides be loaded up or should I share those from my screen as well? Here we go. Okay, so hopefully everybody can see the slides now. Let us know in the chat if you have any problems with the sound or the slides or anything like that. Yeah, so what I want to talk to you about is the really major changes that we've seen in the global LNG market. Huge changes over the last year. You know, the market has been completely turned around from where it was over the last 20 years. And we'll be looking at prices, and we'll also be looking at the flows of gas and how the prices have driven a massive change in the flows of gas around the world. So, as many of you will know, LNG and gas is often sold in two different ways. You have long-term contracts where people buy and sell cargoes for 10 or 20 years. And often the price is based on a price index such as the oil price or a spot gas price reference. And we also have short-term spot trading where people are buying a cargo for this month or next month or 2 months away. Now, on the graph that I've shown you here, I'm showing you the prices over the last 20 years, a big history there. And the first thing that's really obvious is prices in the last year have shot up higher than ever before. Not just an increase, but multiple, many times bigger than they were. Prices of $50, $60, $70 per MMBTU compared to, they used to be around sort of 10 or maybe up to $20 per MMBTU. So a huge increase in prices. What we can also see is a splitting apart between different markets. Now, Japan tends to have long-term imports, a lot of those based on the oil price. Germany has quite a lot of long-term imports as well. They used to be based on the oil price in the early 2000s, but over the last 10 or 15 years, Germany increasingly has long-term contracts based on the spot market price. Whereas the TTF price, that's the price for spot gas in Europe, that spot price has been increasing even more than the long-term price. We can see that between 2010 and 2020, the price of LNG coming to Japan was actually more than Europe because Japan was importing at a long-term price linked to the oil market. And oil was quite expensive, but after the financial crash of 2008, gas was actually quite cheap. So between 2010 and 2020, actually the spot gas price in Europe, the ICIS TTF, the German price, they were below Japan. And because Japan's prices were linked to oil, Japan's prices were more expensive. For 10 years, Japan was probably paying more than Europe. However, when the market moves from a period of oversupply to being undersupplied, the spot price jumps up. And that's what we have now with less Russian pipeline gas coming into Europe because of the events that we have with Russia recently. The market has moved from being well supplied during the low demand of COVID to being very undersupplied, and the spot price has shot much higher. And that's why the TTF has gone up all those times, whereas the cost of gas for Japan hasn't risen quite as much, the actual overall average import cost, because a lot of that is still on a long-term contract. Now, if we look in a little bit more detail about some of the short-term markets, we can see here again the TTF price, that's the price for European spot gas. We also have the UK price, the NBP, the East Asia. This is a spot price for Asia, for Japan, China, Korea, rather than the long-term price. This is the spot price for Asia. Now, those have all gone up together, all those spot markets going up together rather than the long-term. But what we can see is there's a bit of a split in some of those markets. Now, the TTF price, which is the price used in the Netherlands, has gone up the most. If we think of who lost the gas, Germany lost all the Russian gas, which is a big source of supply for Germany. Germany has no access to LNG. It has no LNG terminal. Some of the German companies use the Dutch terminal in the Netherlands. So the Dutch and German price has been affected the most by the energy crisis because they have lost the most pipeline gas, and they only have one terminal until recently, a second terminal just opened in the Netherlands at Eemshaven. But they have limited access to LNG, so their price has gone up the most. The UK in red in the middle, our East Asia index in blue, Japan, China, those have gone up a lot because the spot market is short, but they're a little bit lower because they can still access more LNG. So those countries, Japan, China, UK, Spain, France, they are competing against each other for LNG, so they all have high prices, but they're not cut off from LNG, so they're not quite as high as Germany or TTF. And at the bottom, of course, you have the US Henry Hub price. The US, because of its shale gas production, has plentiful production, much cheaper gas, which is why the US can export so much gas to the other markets. And so when the price of gas has shot higher in the spot markets, that competition between Europe and Japan, those really high TTF prices, they have driven the flows of gas to switch away from Asia towards Europe. The high prices have drawn the cargoes to the Netherlands, to France. We can see that Europe has got an extra 10% of the global market. So this is January to October, the first 10 months of the year this year compared to last year. This year, Europe got 28% of the global cargoes. That's up from 18% last year, so that's 10% more of the market has come to Europe. East Asia, Japan, China, Korea, Taiwan has lost 7%. So a big chunk of the market switched from East Asia to Europe. And also South Asia has lost some, India, Pakistan, Bangladesh, and South America has lost some market share as well. So high prices have taken 1/10 of the market and moved it from Asia to Europe. Within Europe, we can see the breakdown here. This is from our ship tracking platform. We track all the cargoes, which lets us add up the import-export figures. And we can see that the biggest gain was in France. They have doubled their imports this year. That's because France has lots of LNG terminals. It's got 4 terminals on the Mediterranean, the Atlantic, in the Channel. So France has good access to LNG. That enabled it to bring in a lot of extra LNG. Spain has a lot of terminals, the most in Europe. But from Spain, it's a little bit harder to send that gas to the rest of Europe because Spain is at the end of Europe and it doesn't have as good pipeline connections. So Spain has a lot of terminals, but it doesn't have enough demand because it's hard to send the gas onwards. Also, big increases in the UK, which has lots of access to LNG. The Netherlands has picked up, but they only had the 1 terminal most of this year. Germany, of course, would like a lot of LNG, but doesn't have a terminal yet, maybe in a few months. So all this extra gas coming into Europe, this has enabled Europe to refill its onshore gas storage. Europe it's the region with some of the biggest onshore storage for gas. So they can store a lot of gas in summer, ready for demand over the winter. Countries like Germany, France, Italy have a lot of onshore storage. This is old gas fields, salt caverns, etc. Not the LNG terminal storage, but actual underground gas storage. So last year, when we came into winter, Europe didn't manage to fill up all its storage ahead of the winter. That was partly because some of the storage sites being supplied with gas from Gazprom weren't filled up as high ahead of last winter. So on the yellow line, you can see last year the storage wasn't filled up ahead of winter. But this year, the governments in Europe set targets and said, we must fill storage up. That helped to drive the high prices, which pulled in the LNG, but that has worked. If you look at the red line, Europe's storage is now pretty much full up. So by bringing all the extra LNG in, Europe has filled up its storage. And actually, what's really interesting is that the government set the targets, Europe filled up the storage, and now the last few weeks, we've had really warm weather. It's November now. It should be quite cold here where I am in London. But actually, we've just had another sunny weekend. One of the hottest November days on record, I think, recently. It's still pretty warm, mild weather. So heating demand hasn't really kicked in yet. It could be much, much colder at the moment. And then we might need an extra LNG cargo every single day if we all had our heating on. But it's still very warm. And what that means is In the short term, prices for next week are quite low, and we see some tankers are sitting outside Europe. They don't want to deliver straight away because the price for next week is low, but they think December, January, February could be colder. There could be a better price. So in the short term, we've had quite a lot of cargoes building up outside the coast of Europe, what we call floating storage. Maybe 30 or more cargoes sitting outside Spain, a couple of them outside the UK, just waiting and not unloading straight away. I've put an example here of one cargo, the BW Pavilion Aranda. That loaded over 3 months ago. It spent 1 month in the Caribbean, 2 months traveling in circles in the Mediterranean, and then finally delivered into the UK after about 3 months. So it could have made the journey in about 14, 15 days, but it took 3 months to deliver the cargo. And what's driving that, as I said, is the short-term prices. For example, the day-ahead price for tomorrow or the next week, they have dropped because of the warm weather and full storage. You can see here the blue line, the day-ahead price dropping. But what we say as well, this doesn't mean that the energy crisis is over. If we look at the market as a whole, we've still lost a lot of the pipeline gas supply from Russia into Europe. It could still get much colder in December, January, February. There's a lot of winter ahead. And there's a big question about filling up storage next summer. So this year, Europe's storage was filled up with quite a lot of Russian gas as well as LNG. There may be less Russian gas next summer. So filling storage next summer for winter 2023 could be much harder than it was even this year. So we already had high prices this year. It could be even harder next year to fill up storage. And that's why when you look at the orange line, the price for summer 2023, that has not dropped as much. The price for next winter, again, hasn't dropped as much. And people say, well, is there new production coming into the market that will help us, that will make the market a little bit easier? The last few years, we had quite a lot of big new projects from Australia, from Russia, Yamal LNG, particularly from the US, a lot of big projects in the US, Freeport, Corpus Christi, Sabine Pass, a lot of big projects joining the market. The sad news is there aren't a lot of new projects in the next year that will bring extra supply to the market. Freeport LNG in America, a big question as well, when Freeport will restart. That's 15 million tons. It shut in June because of a fire. It's meant to start this month, but we haven't seen it start up yet. So people want Freeport to come back in, and then they're waiting for a few smaller projects which could start up. The good news, just over the weekend, Mozambique started its first LNG project. So congratulations to the Mozambique project and those involved. Eni, the Italian company, operates that. The cargoes are all being sold to BP. The first cargo was just loaded over the weekend, is heading up towards the Suez Canal. So there's some new supply, but a smaller project on the global scale. So yeah, thank you all for your attention to that presentation. I hope that was interesting. So we've heard basically that very high prices, that's taken 1/10 of the market, moved it from Asia to Europe, filled up storage. So things are looking quite comfortable now, but still questions about next year, and that could be a tight winter next year still.
Thank you so much, Alex, for this insightful presentation. We have some of the questions. I remember that you can type the questions. Si tienen algunas preguntas, pueden colocarlas en el chat, que se las estaré pasando. Alex, I have one question here that they sent me in the private. And the question is, who is investing in new LNG contracts?
Yeah, so what's interesting, over the last year or two, we've seen quite a lot of big new LNG contracts signed, these sort of 15, 20-year deals. And the people who build plants, if they want to build a plant, they need to borrow billions of dollars to build a plant. So they say, if you want us to build a new plant, if you want new supply, we need a 20-year contract. We need to know we can sell the LNG so we can borrow the money to build the plant. So over the last 2 years, China has been the biggest investor in new contracts, a lot of big deals between China and the US. And that's helping some of the US projects to make a final investment decision to build the plant. But the question people have had is, Europe has a shortage of LNG, but European companies don't seem to want to sign up so much for the new big contracts. Why is that? Well, I think partly that's because the prices are very high. They don't want to sign up when the prices are high, but also because of their carbon targets. Of course, there's the conference in Egypt at the moment, the climate change conference, and people in Europe are thinking, well, over the next 20 years, we want to use less gas and more renewables, more nuclear. So people in Europe are still a little worried about signing up for 20 years of new gas, even though for the next 5 years, they need a lot more gas.
Wow. Thank you, Alex. Another question that we can pick up from here, well, it's quite ambitious, but what is the outlook for the rest of the decade, in your opinion?
Yeah, so when we look at this winter, at the moment, we look quite comfortable for this winter, full storage, although things could still go wrong. Something could break. It could be cold in January, February. There's a lot of concern about next year because next year there could be less Russian gas into Europe. So it could be a lot of competition next summer to refill storage. Then when you get to about sort of 2025, 2026, 2027, Qatar is the big new project. So Qatar has the North Field, East and South expansions. Qatar is going to have a lot of new LNG coming on in the second half of the decade. It will increase from 77 million tons up to 126 million tons. So all that extra Qatari supply may make the market a little bit easier in the second half of the decade, but it could be a few more years till we reach that area where there's more supply. And of course, in the longer term, there's still potentially a lot of room for growth from China, India, Pakistan, Bangladesh. If LNG were more affordable, if people could switch from dirtier coal to gas, a cleaner fuel, if prices were more affordable, there's a lot of potential still for growth and for extra demand.
Thank you. Maybe the last one here is also to guess, will prices be linked to the oil index? Is one person asking here.
So will prices break away from the oil index?
Yes.
I think we have seen traditionally in Europe 20 years ago, the pipeline gas was all based on oil. But over the last 15, 20 years, Europe moved away from oil to spot gas. I wouldn't see Europe moving back to oil. In Asia, again, we're at the start of that process of breaking away from oil. The current high spot price may make oil still attractive for some people in Asia for longer than it would have been otherwise. But also people are looking for a mix. They're looking at Henry Hub spot prices, which are still low, oil, also the spot prices in Europe and elsewhere. And often when people are investing, they often say it's good to have a mix of investments. So perhaps the best way to de-risk your strategy is having a mixed portfolio of different prices that you use, because of course oil prices can go up as well as gas prices.
It's always risky. Well, Alex, thank you so much. We have more questions, but we need to move on to the next panelist. But we really thank you. You always keep us informed. Everyone that is on LinkedIn is following your news. So thank you so much for joining us for this session today. So
thank you, Kenna.
Most welcome. Continue now. Para continuar, vamos